You're listening to the Pursuing Alpha podcast, hosted by Charles Brandon Snyder.
Yeah, no kidding, right? Well, Eric, I appreciate you joining us, man. This has been a long time in the making. I think this is the second person I've kind of hoodwinked under false pretenses to come onto the podcast because the timing was so perfect. So I appreciate you joining us. It's like you came in from DFW to Lubbock on a whole nother other project. And I was like, hey, while you're in town, come jump on the podcast with me. And so, but it kind of feels like we've been here before. I don't know. Does it feel like we've been here before?
Just a little.
Just a little. So we did a really great 2.5 hour podcast last night, and all of the audio was trashed and computer bugs. Like, I think Ryan deserves a pizza after that one. But anyways, so we're here again. We're doing it over again, which is not a bad thing, right? So I think it was a great conversation yesterday. So let's see what we can come up with today. But first, introduce yourself. Tell everybody who you are, how we know each other, and what's going on.
Sure. So my name's Eric Priamo. Been doing M&A advisory, valuation advisory, transaction advisory for my whole career. Brandon and I have known each other for
8 years?
Something,
9 years, something like that.
Something like that. Going back 3 jobs for me, and I think a couple for Brandon. Mm-hmm. So, we've worked together for quite some time, but I'd say really in the past 2.5, 3 years, we've even worked together more closely, and it's been great.
Yeah, I mean, there's context to that, right? So both me and you came from the advisory services at one of the largest insurance companies in the world, and then they had a wealth management. I was on the advisor side of it, and you were on the consultant side of it because you had a background as a certified valuation analyst at the time, and so you did all the analysis and valuations for that huge broker dealer and that huge insurance company when we were doing things like M&A, buying out and doing all that stuff. We'll get into that in here in a second, right? But that's kind of how we got connected, and we just kind of stayed connected and work really well together. And it's been a great partnership, and it's been a lot of fun over the years.
It has, yeah. And it's great how it's grown too.
Yeah, it's crazy. I would have never thought of this 8-9 years ago that would be, doing kind of something similar, but also together and apart. So we also have like a joint venture that we're building. We hadn't started it yet, but we're kind of getting our feet off the ground where we're doing a lot of the technical sides to high ultra worth advanced planning inside of a software. So it's pretty cool. I'm excited about that, and hopefully one day soon that comes to fruition for us both, because that's a lot of effort and time into it. So, how do companies, just in general, because, I mean, you don't need to be a certified valuation analyst, but I still see you as a valuation analyst, right? You just don't need to have it. You're big enough. You don't need to have that designation, and you don't do certified valuations anymore for people. Right. You still help me out every now and then and answer a question. But my point is saying is I think that most business owners don't have a fathom to how to understand. And after working with hundreds of business owners over the years, I'm 99.9% sure it's not that they're incompetent or they can't learn it. It's just that they're spending all their time and effort working in the business. They don't have time to work on the business to understand all the technical side in the finance world. So how do they go to buy a business or sell the business? Like, what's the metrics? What's EBITDA, right? What's the multiple? How's all that stuff work? Can you break that down so general people can kind of get a glimpse into how does businesses work in your world, and why you would consider to buy them?
Absolutely. And one thing to just kind of touch on that you made me, kind of triggered my mind, is one thing with a lot of business owners. You're right. They may not understand the value of their business, and a lot of that is because most business owners have built their business from the ground up, and it's their baby.
Yeah, American dream.
American dream. And they typically believe that their business is worth more than it is. Now, that's not always the case, but that is typically the case.
We call that the sweat equity side of it, right? So you put so much sweat equity inside of your business, it's kind of like a kid of yours, right? You grew it up from an infant, and had work your tail off on it, 10, 20-hour days sometimes. And then it becomes this good business. And now you're not going to sell it for anything than what you think in your head's a fair market value.
Right.
But how do you define a fair market value for a business?
So look, you can value a business in multiple ways. The most common way for an M&A transaction, a private equity deal, is going to be a market multiple. And that's based off the EBITDA term that you mentioned. So earnings before interest, taxes, depreciation, and amortization. So that's essentially, just real simplistic. Net income, adding back depreciation and amortization because they are non-cash expenses, and adding back interest and tax expense because that's something that can be manipulated by management depending on how you choose to operate the business.
Okay, let's stop right there because that's a lot of technical terms. I don't think anybody or everybody understands those, right? So we have earnings. So you're just talking about gross earnings. So how do you get to gross earnings? And that sales minus COGS, and that gives you gross earnings?
Yeah, so that net income number, right? You have sales.
Okay.
You subtract out all of the expenses, which include COGS, include just kind of general.
COGS are cost of goods sold. So it's like your hard costs. Like if you're selling this bottle of water, right? So you got to buy the plastic for it, right? So that would be a cost of goods sold. So that's like a component inside of it.
Yep. And then the SG&A, selling, general, and administrative expenses, are everything below COGS.
Okay.
Okay, and that might be administrative, might be rent, utility, things like
hard
that.
Cost to run a business.
Yeah, marketing expenses usually down there.
Okay.
So you take out all of the expenses of the business,
okay,
from that gross revenue that you have, and that's how you get to the net income.
And so that's earnings,
or you can call it earnings, if
right?
You want, sure.
So earnings before taxes, right?
Mm-hmm.
Interest.
Yep.
Depreciation's a big one, right? Amortization, hardly anybody understands, right? Which one am I missing here?
That's it.
Okay, right? So let's just go interest, right? So if I run a business and you run a business and we run the same exact business, I might be able to treat my business because I want more leverage, which we'll explain later. So I'm going to need interest that I have to pay because I'm going to take leverage as debt. So I'm going to take on $2 million worth of debt because I want to grow the business faster instead of putting my own money in it, right? But you could run that same business and say, oh, I don't want to take on debt. So to get on a common ground, how everybody evaluates the business the same, I don't think it's the greatest model to do it that way, but that's just here or there.
It's the most common way.
Common way, right? Is you take and add back in the interest as if there was no debt there. That way your business and my business would be valuated the same, right?
Sure.
Same thing with depreciation. So I could choose to go buy 10 vehicles because I don't want to pay any taxes and I wanted to use the 179 depreciation or accelerated depreciation inside of my business to mitigate my tax liability, but I also wanted to buy 10 vehicles to expand to multiple markets. And you're like, no, I'm older. I don't want to do anything. I don't want that growth. So we have to add back in the depreciation or the write-offs that you got for the benefit of equipment or whatever you want. And buildings, depreciation is just anything.
Right. And one of the big things with depreciation and amortization is it's because they're non-cash expenses. So they are expenses that are lowering your income,
right?
Your net income, your taxable income. But there's no cash going out the door for those on an annual basis. You may have $200,000 of depreciation, but you didn't spend $200,000 on that. You didn't.
It's what the asset is lost in value over time that you bought it and you want to push it forward and accelerate that depreciation or whatever it may be, right? But you're adding all that back in so you actually get a higher net income amount.
A lower, well, when you add it back you're getting EBITDA is higher than net income. Yeah.
So again, you're trying to add back all of these things to get on common ground of if you had no depreciation, no interest, no amortization, right? And no debt, everything inside of there is added back into it. So if you just look on what the value of that company is, that gives you that value, right?
That is right. Yes.
So then how do you evaluate what it's going to be sold or bought for? How do you do multiples?
Yeah, so it depends on the industry.
Okay.
And it depends on even the size of the company within an industry impacts it. There could be specific characteristics about one company versus another that makes it worth more.
So you're talking about like whether it's a strategic buyer compared to a competitor buyer, or are you talking about just because this industry sells at a higher multiple because it's a more revenue generating industry compared free cash flow industry compared to a different one?
It really depends. So let's just talk about one specific industry. We'll go back to the air conditioning for a second. So air conditioning. Yeah, the multiples in that industry, depending on the size of the company and the characteristics of the company, could range from 2 or 3 times EBITDA to 15 or 16 times EBITDA.
Yeah, like publicly traded companies actually sell for, on average, like 15 to 16 times. You don't really see that in small business, though. Maybe if it's something special or it's strategic, right? It's usually, what's the norm that you people always kind of need to say, mark your book at this and as a good...
It varies even within the smaller businesses. It can vary quite a bit by the size of the amount of EBITDA the business is generating. So if a business is generating $200,000 of EBITDA, that's going to probably command a much different multiple than a business that's generating $5 million of EBITDA.
So somebody's willing to pay a little higher price because there's so much more value in that higher EBITDA number.
And the reason there's typically more value is there's less risk. So if you have $200,000 of net income or $5 million of net income, right, you got a lot more margin for error if you have $5 million of the bottom line. You could lose, you could do something that, maybe 1 year something happens, right? It could be just the macro economy, the greater economy, causes issues just across the board, and maybe you lose 50% of your business that year for some reason. Well, you still generate $2.5 million of EBITDA. But the other business
only
generated 100,000.
Right.
And what happens if both of those businesses had debt on them? Because remember, we're adding back the interest expense.
Sure.
Maybe that $200,000 EBITDA business had $120,000 of interest expense.
Yeah, so that gets into your burn rate, right? So that gets into, if you had all your debt service payments inside of your business and you take all that back out, you have to have a certain amount of margins and if you have less revenue at the end of the day, those margins could be a lot tighter, or there's a lot less room for error pretty much, right? Before you start going, I can't make my, salary to my employees because I got to pay my debt inside of there because we're down 20 or 30% this quarter.
Right.
I always thought the golden rule for small businesses, and they ask me every time I sit down with the business owner, hey, what do you think my business is worth? And I always have to do the diplomatic, hey guys, I can't give you a valuation on your business, but I will tell you that most businesses in Texas, depending on the industry you're in, can sell for anywhere from 3 to 5 times EBITDA, right? Or they could get as high as 7 to 10 to 15 to 20, but we don't really know until you actually go through a valuation with somebody like you, right? So that 3 to 5 number multiple is kind of always thought that was like, hey, small businesses, you could get 3 to 5 on there. Now, you might get a strategic buyer. You're going to get higher multiple. If you don't have good EBITDA, like you're saying, it's a more risk. You might only get a 3 times EBITDA. I mean, there's one here in West Texas that it's a part of a family that I know that's, looking at selling at, like, we'll be lucky to get a 3 times EBITDA, right? And it's just a really small business. And so there's not a whole lot of growth that you can have in smaller businesses. So I think that's pretty interesting outside of it, but I always, we forgot to do this. So like we did it so well last night. So what's your credentials? I mean, I know you went to a horrible school, but we'll let that one pass or slide a little bit here. So, what did you go get all your degrees from to actually understand all this stuff?
Sure. So I went to the University of Virginia for undergrad, You probably remember the national championship in basketball.
I know, against Texas Tech, right?
Was that 2019?
Yeah, 2019. That was just heartbreaking. The pinky gate is what we call it, right? And so it's like never seen a ball get deflected by another defender, and yet it's the guy dribbling's fault.
We call it the national championship, but and then I got my MBA from the University of Texas.
You went from bad to worse. I mean, being Texas Tech Red Raider and then turn around and having to go to UT, man, that's gonna be brutal there. But I will tell you, the MBA from UT is pretty impressive, though.
It's a good school.
It is a good school, but I will never be wearing that ugly burnt orange ever in my life.
I don't think we want you to.
You probably don't. Yeah, you probably don't. But anyways, and this we talked about this earlier. Like this brings up another deals as like NIL deals going into all these universities were crazy, and so I think it's really interesting how manipulated it is. I think it's such a young thing in college sports right now that there's going to be a lot of trying to figure it out, trying to get it right. And I think they've got it right on some things. We're, having a conversation where my daughter, we went to this weekend and we went and watched Tech softball play. And my daughter, Sage, she's awesome. She's a pitcher at Tech, but she has coaching or teaching lessons for my 10-year-old and also my 18-year-old that's a senior this year. And so she's done really, really well with it. But it was all because of the NIL deals to be able to go in there and do it all right. But you've seen some stuff that's kind of been on the fringe that's kind of been like, holy crap, I can't believe that stuff's going on. And I think they need to fix that a little bit with college sports because, like, you shouldn't be able to transfer and you shouldn't be able to be invited to come predicated solely on NIL deals. What's your thoughts on that?
I mean, as much as I hate to say that something needs to be more regulated, maybe this does. It's definitely the Wild West right now, right? And
it feels like it.
Yeah, and I think it's great that players, athletes are able to get paid for performance, right? Because look, if some student is going to school, not an athlete, and decides to start a business, they're able to make money off of it. They can do something where they make money off of it. So why not let these players make a little money as well, or sometimes a lot of money, depending on the case.
Yeah, I mean, we've seen them worth like $100 million.
Yeah, but what I don't like seeing, and maybe this is even more the transfer portal or a combination of the NIL and the transfer
that's what
portal.
we're talking about. The transfer portal's got to be fixed. I don't think it's ever going to get fixed now.
But it's recruiting out of high school and recruiting transfers. I don't think that it's good to recruit people based on an NIL deal that'd be there. You're essentially paying players to come to your school now.
I think that was the intent all along, but they just kind of masked that intent. But I just think you have coaches that are getting paid to come coach there. You can have players to get there, but they need to have a contract that says, hey, you commit here, you're gonna not participate in the transfer portal for XYZ years, and it gives more stability to the programs. But I'm just talking, as a fan here more than anything, because unless like we're going through it with you with Texas Tech right now, unless you have a coaching change in our basketball program, then it kind of gets funky because a lot of these players actually are there because the coaches recruiting them. They have trust in those coaches to develop them. So, a good buddy of mine, Jason, he's an assistant coach for LCU, and just, we talk about this all the time, and he goes, it's the Wild West in every single aspect of it, and it's very hard to navigate because every single year now going forward, you're pretty much going, I got a whole new group of people coming in because everybody's going to look at transferring. Now,
you're not just recruiting to bring players in, you're having to recruit the team you already have to stay.
Yeah, it's nuts. So I don't know.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
All right, so we talked about EBITDA, we talked about a multiple, but we did not talk about one is asset. So you can do an asset sale too.
Right. We also didn't talk about a discounted cash flow.
Oh, yeah.
Essentially valuing a company off of its free cash flow.
Yeah, that's my favorite thing to look at. So let's do the asset sale one, because that one's less common now, and it's kind of like a company's in distress is the only time I ever see an asset.
Yes.
Somebody passed away unexpectedly, an owner deal, and they're just selling it for the asset value.
Yeah, so there's a few times you see the asset, and that's definitely one of them. Another time is when a company is very capital intensive. And maybe they're really like project based or something.
Give me an
like that.
example of that. Construction company?
Yeah, construction company maybe, or a company that just has a lot of equipment. They may be sitting on $20 million of equipment, like big trucks, stuff.
Heavy equipment. Stuff like that.
Heavy equipment, right?
Or a big manufacturing plant that has a huge amount of
Yeah, so then it depends on how much cash flow they're generating. But there are times, and that cash flow could also be EBITDA, right? Because it could be, talking about the EBITDA and the multiples, maybe they have $20 million worth of heavy equipment, assets, that type of thing, but they're generating $2 million of EBITDA. Well, you're probably not getting paid 10 times.
Right. So it makes more sense to go to the other valuation at the sale of the hard assets instead of the EBITDA number.
Exactly. So there are unique situations, and it is not common, but there are unique situations where you may see that the asset value of the company is actually greater than a market valuation or discount cash flow.
All right. So that jumps right into discounted cash flow. So explain how that works, because I think that one's a really cool one to look at.
For discounted cash flow, you're projecting cash flow out, usually 5 years, sometimes 3 years. And
what we doing, we're looking 10 years out.
Right, but
the numbers get more foggy the further you go out there.
The further you go out, the foggier it is. I mean, even 3 years out, it's really hard to say what the cash flow is going to be for a business 3 years from now. And 5 years, it's even harder. And 10 years, it's anybody's guess, right? Now, for you, you're probably talking about the cash flow for somebody's assets that are going in the market. That's a little different because you look at the market and there's so much history. How much do you get on average year over year?
Right. And so you can look back at that history for 20 years if you need to on some stocks.
Yeah.
You can look back 100 years on some stocks and see what that is. But
yeah, or even just the whole market in general. You're going to get 7-8% a year on average. There's going to be a year that's 25%, a year that's
negative 25.
Negative 25, but it averages out. Right?
Sure.
So it's easier to do in that sense, and that makes sense to do 10 years.
So discounted cash flow, the discount part, I think we need to define it because it's one of those things that a lot of people don't understand. You're discounting future value of money because of inflation, because of risk, because of whatever it is, but you're applying a discount. So if this company EBITDA's numbers $100,000, you might, like we had one project that we were looking at that we had to discount at 14% because there was so much vagueness in the project, right? We had a 4 or 5% inflation rate, and then we discounted, I think, 8 or 9% on top of that because there was not certainty in the deal enough. Right. So we raised the risk parameters inside of it.
Well, and I'll tell you, for most small businesses, 14% is actually low.
Oh, really?
Yeah.
So what are you discounting?
It depends on the type of business and the size, but typically, and now you could say it would even be a little higher just given interest rates and the
geopolitical, everything. Yeah.
But, let's say 12 months ago. 12 months ago, 18, 20, even 22% sometimes, depending on what the business was. Now, there were also times that it was 14, 15%. But I wouldn't go much lower than 14, especially if you're putting debt on the business.
So that debt on the business increases your risk. So your discounted cash flow has got to be a lot higher because you want to make sure you give yourself kind of a pad.
So it decreases the risk, but then part of the discount rate is also the cost of capital. So just to kind of clarify that, so the cost of capital is what does it cost to get equity dollars in? Equity dollars cost more. Debt costs less, but increases risk.
Gotcha.
There's just more risk in a smaller private business than in a large public company. Yeah. Because you could find a small private business that there's customer concentration risk. So what happens if the business has 80% of their revenue with one customer. What do you do if that customer, maybe that customer goes under? Maybe that customer stops using you? You know, that's a lot of risk. You could say there's a supplier concentration risk. You know, let's say if you're, again, the AC company, since we've been talking about that, if you're an AC company and you're using a
compressor that's only made by this one company.
Yeah, one specific manufacturer for your systems, because maybe you get a good deal on them or whatever, and there are some business reasons to do that because maybe you're lowering your costs a little bit. But what happens if a tornado hits their manufacturing plant and they can't produce for 2 months?
Yeah, we've had that happen for some reason over the last couple of years, especially the last 6 months, right? So fires here, everything exploding. Jesus, crazy. But I get what you're saying there. So you're applying different discounts based upon the risk that you're seeing inside the company when you analyze it.
Yeah, so it's called specific company risk.
So you got all these company-specific risks that you're looking at, which applies to the discount rate. So if I make $100,000 and you put a 15% discount rate, I'm expecting to only make what next year? $85,000 instead of $100 because I discounted that free cash flow.
Assuming that 100, when you're doing the discounted cash flow, it's not that you're expecting to only make 85. It's that if you're expecting to make 100. But you're discounting back to a present value.
Right. It's going back into today's value would be.
It is worth $85,000 today.
Gotcha. So discounted cash value is not actually the cash flow you're getting off the company. It's actually what you're only valuing 5 years from now, something that's at 10% discount rate at only 50% of its 5-year value in the future.
Somewhat. It's a little more complicated than that. Yeah, but yes,
that's simple math, right? But it's compounding on top of it. Yeah. So it would be like, 38% or 41%, whatever that math works out.
Well, and on top of that, after the period that you project out, so let's say you're projecting out 5 years, then after that you have to project out for another period of time. But because a lot of people are going to say, it's not really worth it. The projection isn't worth anything past that.
Right. Because you discounted it so much.
Yeah. So it's all right. You're just going to assume that forever a company is going to grow at this rate, at these margins, and there will be one big terminal value. And that terminal value usually represents somewhere around half of the value of the discount cash flow.
Okay, explain that to me one more time.
Yeah. So you project out the 5 years.
Okay, so we're at 5 years. We had $100,000. We put a 10% discount value on it. On simple, we're going to say it's worth $50,000, but it's going to be less than that. But we're going to say it's worth $50,000 in year 5. So you're adding that all back together.
So you're adding in each of these different years all together, right? But if you took that and you said, all right, well, this, $500,000 ends up being, something lower than 500. I'm not going to do the math in my head right now, but let's call it 400,000.
Okay.
In today's dollars. That 400,000, that's not the value of the company.
No.
Right. So nobody, that would seem very low. And that's because the company, we're not assuming that the company ends after year 5.
Right.
It's
going to keep going. You're right.
So the assumption is actually that it continues to operate forever. But at that point, we're saying it's kind of hard to project a growth rate, to project a change to margins each year going forward. So it's every year after that, maybe there's a 3% growth rate.
Oh, so you just you just kind of project a flat number going forward.
Flat number going forward. And the margins are just flat. That's what's going to be every year going forward. And you get down to a free cash flow number, and then that number is discounted back. And you're coming with you calculate a terminal value. And that's basically saying the free cash flows forever into perpetuity past 5 years. What is that worth?
And then you put a multiple on that.
No, because you're discounting that, right? So then you're just adding it in because that's another piece of the cash flow.
Oh, so you're saying, okay, I'm following you now, right? Without writing this stuff down, I'm looking at my spreadsheet in my head going, how does this work? So you're saying I'm discounting for 5 years, and then I'm saying it's a nominal going forward, and then I'm going to pick year 10 and say from year 10 all the way back and adding it back into it, and that's how you're going to get your multiple inside or your EBITDA number with your discounted cash flow.
Well, and we're not even talking about an EBITDA number now.
Yeah, because it's just straight discounted cash flow. So you're taking just your cash flow off this thing, reducing it, leveling it, and then, but you say through perpetuity, you got to give it a time frame eventually to add it all back together. Or
well, if you go forever, right? So like, if you're the way the calculation works, if you're calculating it 20 years out, the number's so small anyways, it doesn't really matter.
Gotcha. I get you because it keeps on actually just decaying inside of it. And so then you're getting your free cash flow and you're evaluating that free cash flow as a part of what do you do with that free cash flow now? Like what is your process to evaluate something once you understand the free cash flow?
So now that you have all this, and remember, this is the projected cash flow. If you have all these projected cash flow numbers and you've discounted them, you're literally just adding up the discounted cash flow numbers, and that's the value of the business in this
scenario.
Okay. And part of that discount, one thing I don't think, maybe we didn't touch on or really hit home is, you have to discount it because whoever is coming in and making an investment, they expect a return, right? So that's a lot of what that discount rate is too.
All right. So that's another cool one. So, I always kind of want to leave it here. Me and you have a relationship, just a personal relationship for, almost a decade. But like you did a lot of valuations for me when I was at my old broker dealer before I went independent. And those valuations were coming into like estate planning valuations that you were doing, right? Or valuating a business to make sure that they, don't end up with estate taxes and shifting assets around or just really, how do I sell my business? There's all of these questions you can come and help support when it comes to a lot of business owners. Well, I appreciate you coming on. I had a lot of fun. It's been a great 2 days here with you. It's good to see you, bud. But I think you're going to have to come back. You're going to have to come back with Ari. You're going to have to come back again because I think there's like 20 other conversations we can have and really drill down to it. But, man, I appreciate you coming on today, though.
Absolutely. I enjoyed it. Enjoyed the 2 days here. I'll be back. Get on again. Conversation was good. I really enjoyed talking about the kids' sports.
Yeah, I did too, man. That's a weird night. All right. Talk to you later. See you, buddy.
Bye.
Thank you for listening to the Pursuing Alpha podcast, hosted by Charles Brandon Snyder. Charles Brandon Snyder offers securities through LPL Financial, member FINRA and SIPC. Pursuing Alpha is a separate entity from LPL Financial. Pursuing Alpha and the logo are registered trademarks. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Any guests and their companies are not affiliated with or endorsed by LPL Financial, Alpha Capital Strategies, Alpha Capital, or the Pursuing Alpha podcast.